What is economics? This is normally the question that we ask when we begin our study of the subject of economics. Economics is a social science. It's about people. Now, a lot of times when we're talking about economics or thinking about economic problems, we're talking about machines and tools and other things, but our interest in them is only to the extent that they're connected or related to people. So economics is a social science. It's more like psychology than it is like physics or chemistry. Now, the reason that we study economics is we want to understand how people use resources. The use of resources and how people use resources is what we're interested in. And the reason is because of scarcity. We live in a world where resources are scarce. Resources are limited. There's a limited amount of resources. Now, for every given resource, they can be used for many, many different things. And these different things, these ends, are competing. So we could use a particular piece of land for a farm or for housing or for industrial purposes, for transportation, for a park, for a school. All these would be fine uses of a particular piece of land, but we can only use the one particular piece of land for one of these at a time. So there's many possible uses, but the ends are competing. So scarcity requires individuals to make choices, to make trade-offs between one thing or another. So with a particular set of resources, we can go on vacation or we can buy a new car, but we can't use those same resources to do both. If we go on the vacation, then we can't buy the car. If we buy the car, then we can't go on the vacation. So inherent in the idea of scarcity is the fact that scarcity requires us to make choices and trade-offs. And in economics, we look at the cost as the opportunity cost. So the thing you have to give up, the cost of the choice that you make is the value of the choice that you did not make. It's the thing that you have, the cost is equal to the thing that you have to give up. So on Saturday night, we can either go out and socialize or we can go to the library, but we can't do both. And so the cost of going to the library is not going out and socializing. The cost of going out and socializing is not going to the library. And so there's this reciprocal nature, which is reflective of the fact that that a trade-off is involved, that the choices involve trade-offs. Now, we should note that when we're talking about opportunity costs, the opportunity cost is of the thing you chose is the next most highly valued thing you didn't choose. It's not all the possible things you didn't choose, but just the next most highly valued thing you didn't choose, because that's really the choice you're making between the two most highly valued things, and you choose one of them and the other one you don't choose. Now, the when we're making choices, when we're making trade-offs, we do them in the context of incentives. Incentives, the choices that we make depend upon the incentives that we face, and incentives can be both positive in terms of rewards, or they can be negative. They can be penalties. But the incentives matter very much in terms of what choices we make and what trade-offs we decide to make. Now, the economic unit that we're talking about when we're studying economics is the individual. And the reason is because only individuals can make valuations and can make choices. And so we know that individuals are the ones who make choices. They're the ones who make valuations, and these valuations are based on they're subjective values, meaning they're specific to the individual, and they differ from person to person. Each person will value a choice differently based on their preferences and a whole host of other things. They make them in a context where the information is always limited, it's always imperfect, and we make the assumption that the actions that people take, the choices that they make, are purposeful. They're trying to achieve something when they make a choice, when they take an action, and that their choices are rational. Now, the assumption about their choices being rational does not mean they're correct or smart or even good. It just means that at the time they had a certain end in mind, and they felt that that was the choice they made was the best way to reach that end. And so individual people make choices. They do it based on their evaluations, which are subjective in nature, with limited information, and we assume that they act rationally when they're choosing. Now, the utility, the usefulness of a particular resource, the thing that the valuations are based on, is specific to an individual. Um, its utility is an expression of preferences. So the value that we're um, assessing when we're making choices, when we're making trade-offs, is based on the utility that we expect to get from the different choices. We're trying to maximize our utility and get the most utility or usefulness out of our choices. And so utility is the thing that determines our valuations. And that's, again, is very specific to a person or to an individual. Now, the most basic tool we have in economics is the comparison of cost and benefits, but we don't just compare any cost and benefits. We compare the marginal cost and marginal benefits. In order to make a proper comparison, individuals weigh the marginal cost and marginal benefits, the incremental costs, incremental benefits that are specifically associated with the choice at hand, with the trade-off that they're trying to make. And so the thing about marginal costs and marginal benefits is they're always forward-looking. We're not really concerned about sunk costs or past benefits. We're at a point in time, and we're considering a choice, and so we look at the costs and benefits of that choice from that point in time forward. They're these costs and benefits that we're evaluating, the marginal cost and benefits, the incremental cost and benefits, are a direct result of that choice, and so that's what we focus on when we're trying to make a decision: the marginal cost and marginal benefits. Now, we know from Henry Hazlitt and his book Economics in One Lesson, we have to be careful. And the reason we have to be careful is we have to make sure that we look at a problem in its totality and not just focusing on one part while we kind of ignore or don't pay attention to another part. Hazlitt's One Lesson, he uses the metaphor from Bastiat about the broken window, and the idea is that somebody throws a rock through a store owner's window, and the store owner has to have the window replaced. And so the idea here is that when he has the window replaced, the person who replaces the window, the glazier who replaces the window, he now gets the money from the storekeeper, and that money is a source of economic purchasing for him. He can hire a new worker or buy a new truck or take his family out to dinner, and all because this shop owner gave him the money to replace the glass that was broken when somebody threw a stone through it. But we have to be careful, because in that example, we're only looking at part of the problem. We're looking, and in doing so, we start to think, well, maybe the broken window was a good thing. Maybe it was the source of economic activity that created, more purchasing for other people. But that's only looking at part of the problem, because what we're not seeing is the store owner had to use resources to pay the glazier to replace the window, and so those resources are now gone. Maybe he was going to buy a new truck or hire an employee or take his family to the symphony. None of those things can happen now because the store owner doesn't have the resources. He had to use them to pay for the broken glass, to have the glass replaced. So in fact, when we look at the problem in totality, we've gained nothing. As a matter of fact, we have one less window than we had when we had before. And so the lesson here is that in order for us to think like an economist, we have to see the problem as a whole and not focus only in on parts of the problem or fragments of the problem. So economists distinguish between two types of statements: positive and normative statements. So a positive statement is a what is statement. And a what is statement, a positive statement, can be tested by checking it against the facts. We can go out in the real world and we can observe what's happening, and that can be a way that we can check a positive statement. So an example of that is the cost of health insurance is $8,211 per family. That's a positive statement. It's a fact, and we can verify that. It may be true, it may not be. When we go out and in the market and see, we'll know if it's true or not. So it's something that can be tested. We differentiate that from a normative statement. A normative statement is not a fact. It's not a what is statement. Instead, it's a what should be statement. Everyone should have health insurance as an example of a normative statement. And a normative expresses an opinion, but it's of limited use to us as economists because it really can't be tested. And so we try to focus on positive statements, which could be tested by observing the real world, and much less so on normative statements, which might be interesting, but can't be tested. So the economic question at hand is, how do individual choices determine how the resources, which we know are scarce, are used to produce goods and services? When we go to the store, it's full of goods and services. How does that all happen? Well, there's three important questions that have to be answered. The first one is, what goods should be produced? What goods and services do the people value and will help them satisfy their wants and needs, will bring them the most utility? So the first question is, what gets produced? And ultimately, the consumers are the ones who decide this through the market process. We have this idea of consumer sovereignty. The products that get made are the ones that people want to buy, and so the consumers really determine what gets produced. The second question is, how do they get produced? And we have resources. We can put them in broad category of land, labor, and capital. And these are the productive resources that get organized into production processes by entrepreneurs. And so all entrepreneurs are the ones who, and sometimes they exist as individuals, sometimes they're in firms, but they're the ones who determine how things get produced. They're the ones who organize the production processes, and part of organizing the production processes, they're choosing what production processes to use. So they determine the how. Now, when we look at the facts of production, we can spend a minute kind of describing them. So land refers not just to real estate, but also to all fruits of nature, trees and streams and things like that. Labor is the time and effort that people devote to producing goods and services. It's the work that each of us does as to produce goods and services. Capital refers to the tools, the instruments, machines, buildings, all the things that we have that are not for today's consumption, but these are things that businesses use to produce goods and services in the future. These are things that we invest in as part of production processes, not so we can consume them, but so that we can produce more goods that we can then consume. And the last is entrepreneurship, which is the organizing principle, the human resource that organizes land, labor, and capital together into production processes so we can have goods and services. And then the last question is, who do the goods and services go to? And the answer there is pretty straightforward. Distribution is a byproduct of the production process. So land earns rent, the labor earns wages, capital earns interest, and entrepreneurs earn profit, depending upon what role a person plays in the production process. That determines how they'll be compensated, be it in terms of wages or interest or profit or rent. And so that's the three questions. Now, in economics, we're also concerned about efficiency and equality. Efficiency refers to using the least amount of resources to produce the greatest possible output in the hopes of creating the greatest possible benefit. When we're able to do that, we say that we're being efficient. That's a different concept than equality. Equality refers in economics to two things. One is in a system where all the people are free to make individual choices in the context of a universal set of rules. And so this is one view of equality from an economic standpoint, the other being a system that creates the same outcome for all the people who are in the system. And so economists will look at equality, and they'll look at both of these notions of equality when they're conducting economic analysis. Now, our goal as economists is to unscramble cause and effect. We want to uh, discover positive statements that are consistent with observations we have in the world that help us understand how the economic world works. But we have to be careful because economics involves complex phenomena. You see, in the natural sciences, you can reduce things to one variable and one unknown, but economics, because it's a social science, we don't have that kind of a situation. We're always left with multiple variables and multiple unknowns, and that's what it means to involve complex phenomena. There's many things going on underneath, and so we create economic models. These models always involve abstractions, but the testing of these models is more difficult because economics is a social science than it might be in other endeavors. It's still something that we do. We go out and test our models against the real world, and hopefully, if our models are accurate, the real world will confirm aspects of our models, and we have a better understanding of how the economic world works. Now, there are many things that economists agree on, but there's plenty that economists don't agree on. You can take the three examples here of three famous economists, Adam Smith, Karl Marx, and John Maynard Keynes. One was a supporter of laissez-faire, of free markets as the best way to allocate resources. That was Adam Smith. One was Karl Marx, who was an advocate of socialism. He viewed the market as being a form of exploitation, that the all value was created by labor, but all the proceeds didn't go to labor, and there was an injustice here, an exploitation here. But in the end result, we'd wind up in a socialist system where all the decisions would be made by the workers, the ones who created the value. And then the last is John Maynard Keynes. In Keynes' view, markets worked. They were the best way to organize resources, but markets also failed. So you had to have government intervention to deal with markets when they failed, particularly when aggregate demand was insufficient and unemployment was too high, and things like that. So there's a lot that economists agree on. There's a lot that economists don't agree on. But in the end of the day, economics is a social science that helps us understand, helps us analyze how human beings deal with the fact that resources are scarce, the choices they make, the trade-offs that they make, and how these individual decisions wind up being playing themselves out in a complex system based on markets and prices and things like that. And so the economic way of thinking is a way of approaching these questions and hopefully coming up with some good answers and understanding how the economy works.